Welcome everyone to the afternoon seminar here with SKAGEN Global. On the agenda today we have two topics. We'll kind of first half talk about the SKAGEN Global in 2021, a fund review of the year, and in the second half we'll talk about the outlook 2022. And at that point we will also go through some of the common questions that we hear from our investors at this point. And if we have time over, then we'll take some additional Q&A kind of at the end of this session. So with that, let's just sort of dive right into it. And I think it might be worthwhile starting by looking at the return figures across the globe for a number of different markets. This is kind of the total return in Norwegian krona from best to worst, at least from the sample size. And you can see that we left out for now just the magnificent returns of one market, giving you a few seconds to guess which one it was. I won't keep the suspense for long here, but I can tell you it was Mongolia that had just a supreme return profile for 2021. And unfortunately, we didn't have any investments there, but it was obviously an sort of astronomical return for that market. Maybe more generally speaking, I mean, it was a great year for the stock market, especially far above the long-term averages for the markets, and we should all be happy for that type of value creation in the market. Moving on then to SKAGEN Global, it was also a very good year for the fund. The absolute figures on kind of number 2 here, you can see for different currencies were high, and on a relative basis the fund outperformed its benchmark by around 12%, which was the best relative performance in over 12 years. So we were happy about that part, of course, and also pleased about the fact that the drivers behind the returns, they were primarily the stock selection. Driver was a key one. And as you know, SKAGEN is about picking stocks. We're about companies, fundamental analysis. We're not so much focused on the making big macro calls. So based on our long-held belief and philosophy about company-specific analysis, it was of course pleasing to see that it was the stock picking that drove the performance. It also meant that, when we kind of close out 2021, that the fund, has a clear excess return stretching back over many years, which again aligns well with our long-term thinking and investing for the long term. Looking more closely at the figures on this graph, you can see the return in euros. We have on a 2021 to the left, and then 3-year, 5-year, and the even longer time periods on the right-hand side, global in blue, the index in green. So also a picture that is at this point looking good. And of course, we never know what the future holds, but we continue to be positive about the fund and the potential for the companies to continue to generate a strong return over the next few years, and we'll talk more about that later on in the webinar. Then just to kind of put some numbers on the attribution. I mentioned quickly that the stock selection in green was the biggest driver of the outperformance in 2021, and this graph is going to put us into context. Selection in green, the allocation in blue, and the currency in dark blue. So again, very much kind of in line with the way that we have communicated what we aspire to do with the fund. Then kind of going into the different names, since we are about stock picking, this is the best and the worst absolute performers during 2021. And on the left-hand side, where we have the top 3 names, we have Alphabet, which is the company where Google sits, having a stellar year. Clearly we've seen ad spend and continue and search delivering great results. We've also noticed this 2021 that the cloud initiative that Alphabet is launching is performing well, good growth, and maybe reaching profitability sooner than the market had expected. And clearly Alphabet's cloud business is now the third one after Amazon and Microsoft, but that is sort of an additional driver that could add meaningful value over the next decade for the company. The number 2, Nasdaq. This is the exchange operator Nasdaq. They obviously own the Nasdaq index, but they also have a number of other areas and they perform well across the board. They actually just released their Q4 earnings a few minutes ago, and that showed that the fourth quarter was very strong again. So we look at that investment case as being fully intact, and we think there's more to go over the next few years for this name. Excuse me, a couple of comments and about the bottom two maybe. Market Access was a name that we thought was a bit of a disappointment last year. This is an exchange for electronic bond trading, and it is a dominant player in that market, and we thought it had good prospects to continue to be that and maybe take even more market share given the network effects that should exist in this environment. But what we noticed last year was that Market Access was actually losing market share in a sort of a continuous matter. And even though market share can of course vary from month to month and maybe even from quarter to quarter, the string of market share losses just became too long for us. It wasn't part of the investment hypothesis. So we thought that the case was no longer following what we had expected, and therefore we exited, but the stock had come off a little bit, during that time, which put it sort of in the lower part of the performance. The UPM and JP Morgan, nothing really sort of big to comment on those names. I mean, they came into the fund in the second half after the summer, and they just weren't really part of the initial increase during the year, but there's nothing that has changed our mind in terms of those companies and their prospects. So they sort of still sit in the portfolio, and we continue to have faith in them, and nothing really kind of major to report from a stock specific basis. Then just also kind of put maybe the fund in the context of our competitors. This is a graph showing you the performance of SKAGEN Global here in blue, and then you have different quartiles for other global funds here. And I guess we can tell from this graph that the fund has performed reasonably well in this environment against the competition, and we obviously hope to continue to be high up on these charts. The sustainability, want to take the opportunity to highlight that ESG and this whole area remains a focal area for SKAGEN Global. We have talked about the importance of this for a long time, so it's not anything new to us. But I think it's still worth to kind of highlight that given our long-term philosophy, the way that we think that our companies should generate value, not just for the next 1 or 2 quarters, but for many years, it is important that the companies take responsibility, that they treat their employees, their customers, their communities, and their suppliers in a good and sustainable manner. And it's obviously something that we spend a great deal of time to try to dig into and understand. And we also, of course, engage with companies if there is something that we think is sort of a clear area of improvement. And just the independent rating from Morningstar puts us sort of on 5 of 5 globes, which we're happy with, of course, and hopefully a reflection that the fund takes this part of the due diligence exercise very seriously. Then I also kind of wanted to go back to this graph that we have shown you in the past, and we will probably show it to you in the future. This is a graphical illustration. It is not the fund, but it's just sort of a picture of how we expect the fund to perform, sort of figuratively speaking. And what we have said is that we expect the fund to go up over time, but just as a reminder that it's not going to happen in a linear fashion. It will be the sort of 2 steps forward, 1 step backward. And that is perfectly normal. We're not aware of any other fund that would always outperform in every environment over every time period. In fact, we think that this type of upward sloping, a little bit back and forth, is very attractive if you can make your fund sort of match that type of pattern. And having said that, I mean, we know that the fund had a weak start in 2021, then it came back pretty forcefully, and perhaps, I mean, putting it on this graph, like we would be somewhere in this area where the red spot is at the beginning of the year. So it's not at all surprising from our point of view that the fund is taking a bit of a breather, stepping back, seeing some profit taking in some of the names, kind of taking that 1 step backward again before hopefully re-accelerating and picking up the pace at a later time again. So this is sort of perfectly normal the way that we look at it. And just to again illustrate that, you know, in a different way, if you look at this graph, the way we think about the time along the x-axis, the return potential on the y-axis, it is human nature to want everything to kind of go up every day and never fall back. And that's of course possible to find that type of investment philosophy. Now, we think that if you follow that investment philosophy, you're not going to maximize the long-term risk-adjusted return. And we see our job, again, as optimizing or maximizing the long-term risk-adjusted returns. And that almost by definition means that there will be some volatility in that journey. And as we say on this slide, the volatility, the ups and downs, which may feel unpleasant at times, that is sort of the price you pay mentally for staying in the game and kind of earning that type of long-term outperformance that we think is possible to generate. So just sort of as a reminder to keep this in mind here when there is a kind of a wobbly market situation, which again is perfectly normal. Probably a good segue into 2022, which has started off a little bit shaky in a way. And the topics that we keep getting questions on is about inflation. What is happening in the US? How do you protect against it? How long is it going to be there, and so forth? We also have some people wondering about commodities. Is maybe now the time to buy in? And that is probably driven by the notion that commodities tend to be might be a good protection against inflation. Then, given what's happening on the geopolitical arena, Russia, Ukraine, how is that impacting the fund? And lastly, about the portfolio, kind of given what's happening in the market, are you making any changes? What do you think about the sector rotation? Comments generally on performance, and we'll get into all of these topics here now in the second part of the webinar. So beginning then just kind of with the forecast, and when we look in the crystal ball for 2022, and we've said this many times in the past that, you know, we never try to make detailed projections on GDP growth or exactly where interest rates are going to end up or which currencies are going to outperform. I mean, those type of macro forecasts are kind of beyond our ability, and we keep a very clear focus on the companies. But having said that, of course, we understand that every company operates within a sort of social, political, economical context. So you can't completely turn your head away from what is happening on the macro side. So that's why of course, we have a view on things, but we're not able to, again, kind of give those type of detailed macro updates. But diving into inflation, which is of course something that has been affecting all of us and in our daily lives, and these are numbers from the US, very high, kind of on a year-over-year basis. Though one should remember that there's a base effect in many of these year-over-year numbers that you may see reported. We know 2020, kind of when the pandemic hit, that things kind of came to a standstill. So you got to be a little bit careful, or at least critically think about some of these year-over-year changes, given that the base may be very, very low. But needless to say, there is clearly a big amount of inflation in the system, not only in the US, but we see it also in the Nordics or here back in Europe. So that's fine, but then what about kind of going forward? How do we think about this, and what is the market sort of telling us at this point? Well, from our point of view, it's not entirely surprising to see this type of high inflation. Those of you who joined us last year may remember that we talked about this slide in January 2021, where we pointed out the ballooning balance sheet of the Federal Reserve in the US, obviously driven by enormous stimulus packages kind of being launched, and followed then by essentially helicopter money, sending checks to people to spend money. I mean, that is, I guess it's fairly straightforward to understand that's going to lead to some type of inflation in the system. So again, it's not something that is taking us completely by surprise that there is a fair amount of inflation out there. The question is, of course, what's going to happen with it going forward? And we put in here a couple of graphs from the Bank of America Global Fund Manager Survey. This is a survey that goes out to several hundred global fund managers, and the results here just came in a little bit more than a week ago, and it shows you what the kind of average global investor believes, and puts kind of things into context a little bit. It doesn't mean that we always agree with what the average fund manager believes, but it's hopefully helpful to understand kind of how the market is, what the market is projecting, on some of these key measures. So looking at inflation then on this graph, the one to the left, you can see that there is some mixed views, but still kind of quite a big portion of investors expecting that inflation has peaked. Yeah, and that may of course be driven by, again, the base effects, that inflation in 2021 was elevated against those effects, and it may not be quite as bad as we go through 2022, and it could be kind of tapering off over time, especially if you also add on interest rate hikes to cool down the economy a little bit. On the right hand side, we have the question, is inflation transitory or permanent? No big change over the past month among investors, and roughly a third believes that it's permanent, and 2/3 believe that inflation will indeed be transitory. SKAGEN Global, we don't take a firm view on this. We don't think that we necessarily have much to add to this debate. We think more in terms of how can our portfolio and our companies navigate an environment regardless if inflation is transitory or permanent. And before we kind of go into how we think about that, let's talk a little bit about the inflation hedges, and that's a question we get sometimes. And one thing that has been out a lot there in the media is about cryptocurrencies being kind of big, great inflation hedges. We will leave it up to you to decide if you think that is true or not here, but since kind of peaking in November, we can see on this graph that Bitcoin has fallen by 47%. So I guess not totally insulated against inflation. And just to be very, very clear that SKAGEN Global, we're not in dabbling with cryptocurrencies. We're simply showing this graph since it has been something that has come up, a lot of in the media and conversations lately. The way we think about inflation, and what would make our portfolio not immune but maybe resistant to some extent against inflation, is if you go back and look at our fundamental investment philosophy. And here are the cornerstones that we have talked about in the past, and the one to highlight again is competitive advantage, meaning that we believe that most of our companies, they offer some type of unique product or service that they will be able to price up if there is inflation taking root in the system, and that's of course going to help them drive a higher top line. Of course, higher inflation may mean higher interest rates, which could translate into a higher cost of capital, and then you have the effect of bringing down valuation if there is a lot of that part for a company coming from the future. But on the other hand, if you can pass on the inflation, and sometimes maybe even more than just pass it on, then you can to some extent compensate and perhaps even overcompensate in some select cases by having that higher top line, meaning higher cash flow coming into your companies. So we look a lot around this concept when we select companies, and we continue to believe that our portfolio is well positioned to perform over time, also if inflation tends to be a little bit higher going forward. It doesn't mean that it's going to be the case every week, every month, every quarter, maybe even not every year. But again, taking the long-term view and thinking about the 3 to 5 year investment horizon that anyone investing in SKAGEN Global should have, we believe that we are well on track to continue to sort of do well as we look out in the years. The main instrument for battling higher inflation by the central banks is obviously putting up the interest rates. And sometimes people worry that, well, if you put up the interest rate, isn't that going to be kind of, a type of gravity for the stock valuations, meaning bringing stocks down? If we look at the American market or the US market, this graph goes back all the way to 1992. You will see that the areas that are shaded in green, gray color, they are areas when the central bank in the US, the Fed, was hiking interest rates. And as you can see on this graph, during these periods, stocks often continued to climb. Again, wasn't necessarily always up, in a straight line, but overall they did pretty well even in those environments. Sure, the derivative or the slope wasn't as steep, meaning that the stocks didn't go up as much during these periods as they did during other periods. But we don't think that there's any cause for alarm just because the Fed puts up rates, a little bit. In fact, it can actually be quite healthy to try to combat the inflation, so it doesn't become overly punitive in the market and to consumers and businesses. Moving on to the next topic about commodities. What do we think about commodities? I mean, it's now the time to pile in to commodities. And the reason commodities come up is because that is often seen as a hedge against inflation. And there is certainly some truth to that notion. But it also means that this has been known for a long time, and maybe it's not a coincidence that if you look at oil, for example, trading up at around $86 per barrel for Brent oil, I mean, that is sort of toward the higher end of the range. The graph down here on the left-hand side shows copper. This graph goes back all the way to 2002. And you can see that we're now kind of up in the at peak levels when it comes to the metal price here. So doesn't seem to be kind of a great buying opportunity, if you agree with the notion that buying at peak level usually isn't really the best entry point when you do investing. And we can also see, if you look on the right hand side, here's a graph from Bank of America from the survey again, showing you that we now actually have the highest net allocation to commodities. These are the kind of the small blue charts or bars in the background. Now that we've had since 2006. So again, when something is very popular, trading at peak levels, to us at SKAGEN, who have a streak of being contrarians in us at least, that doesn't really signal that now is the time to pile in. We would be much more excited about this area if they sort of were bombed out and nobody wanted to touch them. Even if we thought there was still sort of a good fundamental case for it. So currently probably not the area that we're gonna be adding a whole lot to exposure to now, but we also know when we can look at these graphs and see that things can change very quickly. So again, we keep an open mind. We have a broad mandate, an unconstrained mandate, and when the time and valuation is right, then we will certainly have a very close look at it. Then geopolitical risk, something that has been in the newspapers a lot, obviously, kind of given what is happening in Russia and Ukraine. And we don't have any direct exposure in Russia. We haven't had that for a long time. So if something were to happen there, of course, it would be, I mean, needless to say, negative implications for the stock market, but we're not seeing any of our holdings being directly impacted by that. But I also want to take the time to again just reiterate what we've been saying in the past, namely that political risk is something that we think is worthy or merits very close analysis and consideration. It is a key part of the risk framework that SKAGEN Global applies to its portfolio. And just to kind of give you one example, a little bit more concretely, is from Turkey, where this graph basically shows you how the Turkish market, MSCI Turkey, has performed compared to the global index, MSCI all countries, world all countries, going back to 2016. And 16 is because we in SKAGEN Global, we haven't had any direct investments in Turkey or in Turkish companies, Turkish listed companies since that time period, in part or maybe in large, because we think that the political risk has been very elevated in Turkey, and it hasn't seemed to be the environment which has been particularly conducive to companies delivering a lot of shareholder value to international investors. So again, but having said that, they can always be specific, I mean, company-specific investments in any market, and we don't mean to kind of put a ban on anything. You know, we keep an open mind, but we certainly take political risk into assessment as we look at where to allocate the fund's capital. Thinking about risks, to maybe close off this section, again, this is from the Bank of America study. It shows you what investors think about, you know, what are the biggest tail risks. And as you can see here, hawkish central banks, so meaning kind of a lot of interest rate hikes, probably in pretty quick succession, going up together with inflation are the main risks. Whereas, you know, the COVID, the pandemic risk, or US-China geopolitics, they take a back seat and aren't really considered to be the biggest threats to the global market at this point in time. Obviously, it can change quickly, but that's where we stand as of mid-January. Then, kind of looking at the more closely what's happening in 2022. Clearly, there has been a setback for the market. This graph shows you the global index, MSCI all country world, going back 1 year in time, and certainly a meaningful pullback over the first sort of 3-4 weeks here in the year. At this point in time, we think it's always instructive to take a step back and maybe look at the longer term picture. And when you do that, again, looking at the global index, but taking a 25-year snapshot of the development, the pullback here in January that feels brutal currently isn't, much more than a blip if you take this long-term view. And we think it's also worth pointing out at this point that the reporting season has just begun. We haven't been through a lot of companies, kind of making big assessments about the market and how the companies are performing seems to us to be a little bit premature. And also, if we look at a couple of specific indices, let's take the Nasdaq. This is the Nasdaq index. It went into a correction on January 20th. A correction means that it fell by 10% since its previous peak. And it may sound a lot, it causes a lot of news headlines, of course. But if we look at the past decade on the graph on the right-hand side, you can see that the Nasdaq has gone into a correction mode, almost a dozen times in the past decade. So, basically once per year. So it's nothing to be overly alarmed about at this point. And of course, it can go down a little bit more. It's possible, but it's not something that is very unique, even in a sort of near historical context. We also think it's worth to kind of think about it that it could be an opportunity. This is the S&P 500 and how it has performed after it has gone into correction mode, but not all the way into a bear market, meaning it has gone down more than 10% from the peak, but not as much as 20% from the peak. And then if you look at how the market performs after it has kind of troughed to reach the bottom, 3 months after, 6 months after, 9 months after, and 1 year after, I mean the historical figures, this goes back to 1970, so 50 years of history, shows you sort of a fairly good statistical picture of things. It is obviously no guarantee, but it indicates that this might well be a pretty good entry point, or at least time to add exposure to companies around the world. Then when we look at how investors are positioned, this is a graph again from the Bank of America study showing you what is popular, what is unpopular in an historical context. And history in this case goes back around 10 years. Yeah. So from that kind of over the 10-year history, currently banks, commodities, materials are very popular among investors, whereas bonds, technology, emerging markets are out of favor. Can probably be linked to, that people are expecting inflation, they have commodity hedges, they have banks because interest rates are likely to go up. That is probably at least the simple explanation of the current narrative and general investor positioning. We look a bit beyond that, and when we sort of look at 2022, we think one of the key things to be aware of what's going to be important, not just this year, but maybe even more so the next couple of years, is what is happening in the US on the 8th of November this year. That's when we have the midterm elections that will decide the composition of things like the Senate in the US, and Congress going to be looking at that as well, the House. So that's going to be interesting to see how that turns out, and we think that again that would be an important result in many aspects for long-term investors. Then I kind of want to run off by saying a few words about the fund, the portfolio, how we are positioned. You remember that when we looked at the graph, how the average investor is positioned, they had a lot in materials, they had a lot in energy. Banks, we have one bank, we have JP Morgan, which is more than 4% in the fund. But overall, we have maybe a slightly different composition than what the average investor has currently. Now, when we look at this picture and the breakdown of SKAGEN Global by sector, we think that it is a good balance between different sectors, also different geographies, and most importantly, it is driven bottom up by our analysis of specific companies and that we have found that we think can deliver outperformance over our investment horizon. Of course, it's been a bit of a tough start for the fund. I mean, that is something that we acknowledge, but we also note that there has been very little communicated from the companies. So, if a company kind of goes down by 10-15% and there's nothing has been communicated by the company, we think it might be an overreaction and maybe driven by technical factors rather than something company specific. So far, we've only had 5 companies reporting, at least as of last night, and these are these 5, and they have come in on average pretty well. We don't see any big negatives. Of these names that we've had, the Microsoft came in last night, and we thought they produced a reasonably good report. So it was a little bit surprising to see that the stock initially went down in the market, but we think that when the market begins to digest and maybe look more closely at the results, that it will be a positive reaction in the stock. So to us, Microsoft continues to look very undervalued if you have a multi-year investment horizon. But the main message that we wanted to send with this graph, this slide, was just that we have around 30 names in the fund, only 5 have reported so far, and we're going to spend the next few weeks talking to the management teams, reading the reports, hearing the conference calls, debating it with the internally and externally, updating our financial models, and assuming that everything looks fine from a company point of view, then that would give us a lot of comfort into that we have a very well positioned portfolio going forward. And so far, we have really no indications that would point us in a different direction. Here is a lineup again. You've seen this slide before, so I kind of won't go into all the details here, but we think that the team looks strong, and we look forward to kind of getting more results from the companies over the next, like I said, the next few weeks. And then as a final reminder, this graph shows you from a kind of portfolio perspective that there's no number of things that everyone can invest in, and we think everyone needs to think about their portfolio from a personal point of view and personal circumstances. But one thing that we think would be in common for institutional investors, for private investors, for retail investors, is to have SKAGEN Global as a foundation in a portfolio. We think that is a very good place to place some of the long-term savings and perhaps pension money. We will continue to follow our philosophy. We have a clear investment philosophy and that we will continue to execute in a disciplined manner. And as we look out now, the portfolio seems to us to be significantly undervalued if you take a 3 to 5 year investment horizon. With that, I will turn it back to our host, Ole Christian, if there are any final questions to answer.
Knut, thank you very much indeed. And we do have a question, and I think you actually answered it, but let's go with it. We have one person wondering, do you have any idea as to how long the recent turbulence in the especially in the developed markets will last?
Yeah, I wish I knew. I mean, if I knew, I would certainly share that with you here, but I think we got to be honest and say that I don't know. I don't think my colleague Chris Tommy knows either. I mean, we're not trying to make those predictions, and quite frankly, we're not sure that anybody knows, when the market is gonna bottom. So that's impossible to say really, and we think again, just kind of stress the fact that to be mentally prepared that there has to be periods of turbulence in the market, because I mean, think about it. If you had the same stocks go up all the time, then everybody would own those stocks and nobody would own any other stocks. So there must be times when they would be worth to buy some of the other stocks. Now, for us at SKAGEN Global, when we have a 3 to 5 year or even longer time horizon, that means that we look at certain characteristics in our analysis. But there are many other people out in the market who have much shorter time frames. I mean, it could be seconds, milliseconds, or weeks, or months, or maybe up to a year. And of course, for them, it doesn't matter that Microsoft, might be undervalued on a 3 or 5 year view. What matters to them is, what can happen in the next week or two. So that means that it's going to have to be some of these violent swings in the market, so that it's possible to make money also in all kinds of other stocks. But for us, that is more of a buying opportunity that we can add to our holdings at even more attractive valuations. But we just have to have enough comfort in our own hypothesis valuation, so that we don't get scared just because something goes down, in a short time due to speculation or just some short-term trading that we can't really control.